Life insurance for solo coaches is one of the simpler decisions in this module, but the simplicity gets buried under the volume of products the industry pushes at you. The principle resolves in two sentences. If you have dependents who rely on your income, carry term life. If you do not, the urgency drops sharply and the decision can wait. The complication is what happens when a broker or agent walks you toward whole life, universal life, or variable life instead of the simple term policy that almost certainly fits your situation. The unit covers how to handle that conversation when it arrives. Dependents are the gate. If you have people who rely on your income, a spouse who would not be able to cover the household, children whose support depends on what you earn, an aging parent you contribute to, then carry term life. If you have none of those, the urgency drops sharply. You may still want some coverage for funeral expenses or to leave something behind, but the size of the policy and the urgency of the decision both change materially. The principle is simple. The volume of products in the industry is what creates the friction, and the volume is the reason this video exists. Term life does one job at a fixed annual premium for a defined number of years. Pick a term, 10, 20, or 30 years. Pick a face value, the death benefit your dependents would receive if you died during the term. Pay the same annual premium for the life of the term. If you die during the term, the policy pays. If you outlive the term, the policy ends and nothing pays. That is the entire product. For a coach with dependents and a fixed coverage need, this is the right product. It is easy to understand, easy to price across carriers, and easy to compare on the only two variables that matter, face value and annual premium. Permanent insurance bundles a death benefit with a cash value savings component, and the bundling is where the cost and complexity both come from. Whole life, universal life, variable life, different flavors, same architecture. Death benefit plus tax advantage savings inside the policy, with higher annual premiums than equivalent term, and with fee structures that are difficult to compare across carriers. The case for permanent rests on three conditions: a very long-term estate planning need that runs past age 70 or 80, exhaustion of other tax advantage savings vehicles like 401k and IRA and SEP, or a specific business succession scenario requiring a permanent vehicle. Most early career coaches meet none of those. When a broker leads with permanent insurance instead of term, the single most useful move is to ask them to model the term equivalent and explain the delta. The comparison is the discipline. Same face value, same insured, same health class. What would a 20-year term policy cost annually? And what does the permanent policy cost annually? And where does the difference go inside the permanent structure? The broker who can run that comparison cleanly and explain the gap in dollars is the broker you can keep working with. The broker who hand-waves the comparison or steers you back to permanent without numbers is the prompt to get a second opinion before binding anything. Two coverage amount methodologies, and you use the larger output as your target. DIME is the more precise of the two. Debt plus income times years of dependent support, plus mortgage plus education costs for any dependent children. Sum each line, and the total is your DIME face value. The 10 times income method is the conservative floor. Annual income multiplied by 10, single calculation. DIME is better for complex situations where the dependent timeline is well defined. 10 times income is the adequate starting point when the situation is straightforward. Run both. Take the larger output. The marginal premium difference between the larger and smaller number is small relative to the protection it buys. Online quoting works for standard applicants. No significant health history, non-smoker under 50, no high-risk avocations. Policy Genius, Term for Sale, direct carrier sites all give you fast quotes that compare cleanly across carriers, and the application process can complete within a week for a clean case. Complex situations route to an independent broker. Significant health history, controlled chronic conditions, high face values above 2 million, business succession structures, or avocations like aviation or scuba that affect underwriting. The Module 3.5 broker who handles your E&O may or may not specialize in life insurance. Ask explicitly before assuming they are the right placement. A 38-year-old coach with 2 dependent children and $6,000 a month in income. Annualized to $72,000, the 10 times income calculation runs 72,000 times 10 equals 720,000 face value. Her former employer group life policy lapsed when she left the corporate role 2 years ago, and she has been operating without coverage since. She quotes a 20-year term at 720,000 face value on 2 online platforms. Standard health class. Binds the policy within the week. The annual premium is small relative to what the policy actually protects, and the decision was simple once the methodology gave her the target number. If you have dependents and no current coverage, the next move is the calculator and the quotes, not the broker conversation first. Open the life insurance need calculator. Run both methodologies, dime and 10 times income. Use the larger output as your face value target. Get at least 2 quotes from the online platforms before binding, because the carriers price differently, and a 15% spread across carriers is common at the same face value and term. If your health history is complex, call a broker before quoting online. Underwriting outcomes vary by carrier, and a broker can route you to the one most likely to write your application at standard rates.